Good morning, ladies and gentlemen. Well, what a very interesting start to the year 2019 we've had. If you remember, the risk dial was at -84, stuck for a long time. Then a couple of days ago it improved to -80, and Friday it improved to -76. Hardly the stuff that dreams are made of during this rally. Prices are improving, but spreads are not improving so much. I know exactly why it moved from -80 to -76, and it only did so by a few ticks because of a few ticks of the settlement. That could be given up at any stage. So the spreads are still very negative, and we shall now examine the reasons why and what could be lying ahead in the next couple of weeks. It is always useful to frame any discussion of prices and where they might be going by seeing the fundamental picture. Where are we? We are back again at roughly times 15 earnings, with the Blue Angels slightly descending, something like we had in 2014 and throughout basically 2015 and the early part of 2016. So we went sideways with some very sharp corrections for the best part of 2 years. Much the same could be happening here, we don't know, but that is why I've titled this week's video the way I have. It's all in the economy. We are now having had the dump, i.e. having had people stopped out left, right and center of all their positions. We are now regaining balance and going back to where we could have been all the time had we not had the panic that Jay Powell basically he caused it. And then he tried to repair it, but I think it's too late to repair it. We shall see. We're back at the times 15. If we look at the individual sectors, we'll see that discretionary hasn't really changed all that much. Discretionary is still rich, but the Blue Angels are going sideways. They're not doing anything, indicating that discretionary will not be the part of the internals that will give us the best signals. Staples much the same, they're not going anywhere, and energy, too small a component to be of any use. Financials are the ones that could actually give us a bit of a surprise rally to the upside, simply because we are so far away from the times 12. We could have a surprise to the upside in the financials if the earnings season next week starts well, so that could boost the index slightly. And healthcare is the one that I still like because it's defensive and also it is not expensive. It is going sideways. We could easily see healthcare go back to very close to the highs in the weeks ahead. Industrials, well, they will wait around here, I'm quite convinced, because we could be getting some seriously weak economic data in the weeks and months ahead, and I don't think people will be too keen to buy the industrials and take them much higher. They could take them a little higher, but not very much, is my opinion. The industrials are the ones that I would leave alone because they're the swing factor. If the economy is bad, they're going to move like shit of a shovel to the downside. And if the economy is as expected, well, the risk reward to the upside is 1 to 3 at these levels, not the sector that I would be long of. Technology is the one that could give us a little bit of a lift, simply because we have discounted much more than the forward earnings, but that again is completely dependent on trade. It's completely dependent on economic data. As we go up, the risk reward in information technology gets worse and worse. Again, one which has lost leadership, and once you lose leadership, you don't tend to regain it immediately. It takes time for that to develop. So I am rotating away from the sectors I've just mentioned to more healthcare, some consumer discretionary, staying, having my money invested there where it is probably at least risk of being hurt. Let us start straight away with the bonds then. The 5-year, if we then enlarge it, it is quite clear that we have had the puke out, and now we are basically going to be trading between 267 and this kind of level, 242, but I would actually say that it's like 246, 248. 267 is going to be a very good top. That is like the level that I would love it to trade. If it did an A, B, C towards 267, or that is the level that we really want to get involved at and be long of 5-year notes, the belly of the curve, 267, because the risk reward there is very, very good. The 10-year chart is nowhere near as pretty as the 5s, but that area is somewhere here. It's somewhere around the 280 to 283 level. Again, if that is an ABC, probably goes up towards this 286 level, but that is the kind of area that you want to be involved in, and having a decent position in calls in the 10-year note. The 30-year is even more difficult. Basically what the yield curve is saying, the likelihood of the very short end being hurt are low, while the likelihood of the long bonds being hurt is higher. So what we could easily see is, this is TLT, we could easily see TLT come down towards the 117, 118 area where it traded for such a long time throughout last year. And then that will probably provide us with a spring to go back up towards 125 to 127. But I just am not as bullish as most people are of the long end. I am much more bullish of the short end. I think you keep your money in the short end and trade it leveraged there. To me, that is a much safer bet. If we look at the spreads between Europe and the US in terms of yields, we will see that they are still, having had this fake out, they've returned toward in their range in which they traded for the best part of last year, which is 245 basis points to 258 basis points, basically a range of 13 basis points. I mean, nothing. And until we get significant closes outside of that range, that will keep the dollar fairly steady. We'll look at the dollar in a moment, but that to me says that the movement between the 10s in the States and in Germany is going to be fairly minimal for a good while. If we look at a weekly chart here of the Bund, you can see what it's saying. It's saying that the downside is fairly limited at the moment because it's being contained by these Bollinger Bands. It's more likely, the charts are saying, to go back up to 28, 30 basis points than go that much more on the downside. That to me says that you don't want really to be invested too hard in 10-year notes, simply because on a spread basis, if the previous chart is right and the spread relationships are going to be fairly steady, that says that the upside in 10 years is very limited. and therefore there's no point in holding 30s or 10s. Much better to be in the very short end and take your chances there, and then rotate into the 30s and 10s when the targets I've just mentioned are achieved in the IEF and TLT. Here we are with the dollar index. It basically is respecting these lines very well indeed. It bounced off 95.07, which is the level that we've had here for years, and the 200-day moving average is now supporting it. So basically you want to buy dips to 95.07 to sell them at 96.50. That's what we've done, and until this moving average is broken, there's very little chance of going to 96.63, which is the level that we've had for such a long time in mind. But once it gets there, it's option city, because volatility will really start picking up. If it gets there, it will make a big move one way or another, and I mean big, I mean 10%. I wanted to show you the risk on, risk off yen because it had that very interesting move down to whatever it was, 105, but it never closed below this very important 108.22 level, which I've had here for years as well. To me, this is far more likely to go up, back up towards 110, excuse me, 110, 111, and then move down than it is to do anything else. That would say that there is some strength in the dollar coming up and some moderate, mild risk on, couple of percent to come. And after that, well, it looks like God help us. But I think certainly in the next, don't forget this is a weekly chart, it's certainly for the next 3-4 weeks, I think the likelihood is that we go up into the 110s rather than have a complete nightmare and collapse. Now, how does all that I've just said tie in with ES? ES is doing absolutely nothing wrong. This was where one should have bought it, which we did. We bought a rut, we got out far too early. Got bearish far too early, but that is the way the cookie crumbles. It's ever since last Friday when it did this move and the moving averages all went positive, it's done absolutely nothing wrong. It's traded the way a bull market trades, which is in a nice narrow range, price above all moving averages. It's respecting the Bollinger Bands, no panics, no nothing. To me, this is a chart which is far more likely to test some upside than it is to collapse. I think some more time needs to pass to get all these moving averages completely bunched up around 2600, and then we can at some stage go through it and stop everyone out. This gap here is likely at some stage over the next several weeks to be filled, but I think there's a lot more pain for the bears in the meantime. So that is what this very short chart is saying, and now we'll look at all of them in time progressions. This is the daily. I've just done a quick ABC, and you can see that really the 100% comes at 2617, and the 138, which is probably likely at some stage to be hit, is 2684. So very good support now, 2550. To me, it's more likely to slowly stop everyone out, test the upper Bollinger Band, which is what, 2660. It's coming down, okay, so it'll probably be 2630, 2640. Stop everyone out, slowly roll over, then come down, and then retrace back to the middle. It's a market which basically could be doing something like here, slowly going up, coming down, stopping everyone out, and then, you know, basically trading towards the upper end of its range. What does that tell me? It tells me the volatility is going to stay offered. It tells me that there is no panic. It tells me that the market is looking for direction through time and the data that that time will provide. If you think about it fundamentally, it's very simple. The market thought imminent recession because Powell said that he wasn't going to do anything about it. He didn't really care about asset prices. So the market had a nightmare. Powell then comes back and says, oops, I didn't really mean it. Yes, we never meant it. You interpreted my words wrong, which is of course rubbish. But he obviously blinked. So a lot of people think that we have the Fed put back on the table. I don't think so. I think that's a mistake, but the market is going to take an awful long time to discover whether it's true or not. It's going to take fundamental data now for that to happen. If now the ISMs continue lower, if now unemployment turns, these are all things which are not going to happen tomorrow. These are all data points that we're going to get in the next months. And that is when the market is going to have a complete nightmare, because Powell will just not be able to deliver on his promise. What's he going to do? Well, he's only going to do something if the market is significantly lower. If the market is down here, he will act. Well, great, but the market has to get down there first. So the idea that we have a Fed put at 2600 is just stupid. We probably have a Fed put at 2300, but certainly not at 2600. Right, moving on to the weekly chart. Well, here we have it. Bounced right off the tick. I mean, I was off by 10 ticks. So if we enlarge this, we'll see what's happened. We've gone back into the Bollinger Bands. It was never sustainable to be outside of the Bollinger Bands by so much. And now, you know, everybody's covered, and basically we're going back to this red line where it did so much work and it just could never ever stay above it. It's coming down next week. Of course, it'll be somewhere down here, but that is what, 2667, that kind of area. So that is your upside. That is your maximum upside. I doubt it gets there. I would have thought 2640 is going to be easily enough, but what's 0.5% between friends? So it's still rolling over until these levels are taken out. I remain bearish longer term. I think that those levels are going to be excellent levels to short rather than the other way around. And even more importantly, the monthly is on a sell. If we enlarge that again, I mean, look how beautifully it just touched the line. And where is all the action? 2665. So we have the daily projection of the ABC, we have the weeklies, we have the monthlies. They're all bunching at 2665, 2660, 2650, whatever it happens to be, within 1%. So that is the area where the big fight is going to take place. That is the area from which volatility can expand. And here's our very good friend, the VIX, on a weekly chart. I like looking at it on a weekly chart. It tells me a lot. Let's enlarge this. You can see that every time there's a big spike, and this is the February spike, it comes back for a few weeks, then has a little move, then comes back. But it takes time to develop the fuel for the next spike up. That tells me that we're going to go down towards 17, slowly go back up towards 24, 25, then come back. That to me is a market which trades between 26, 60, and then has a fright goes back down towards 2500, 2450, 2400, and then right back up. It's a market which is going to be in a range for the next several months, simply because it's looking for fundamental data to make the next big move. And as I've just told you, that fundamental data is not going to come next week. It's not going to come in 2 weeks' time. We're talking about ISMs. We are talking about unemployment numbers. These are not things which come around every day. On a shorter time frame in VIX, this around 1650 is going to be a fantastic level to buy it. The risk reward there is going to be so skewed to the upside, it's not true. And that could easily coincide with 2650, couldn't it? So that is really where I would like to get involved with volatility. Our old friend the DAX. I mean, what a beautiful touch. Incredibly how beautiful technically all these markets have been. Fantastic touch down at 10,285, and trend line. Believe me, I haven't put these trend lines in. They've been in there for years. Okay, they've been in since 2012. So this is what the market is saying. Probably more room to the upside, to around even 11,400 at some stage. But if we enlarge it again, to me this is basically a big trading range between this trend line and 11,366. That is the level that I would love to get involved on a longer term basis to the downside. But in the meantime, that is you know, 10,200, 11,300. So 10,300, 11,300. That's a 6% range. It's not an unreasonable thing for the market to do, is it? Monthly chart of Nikkei. I mean, look how beautifully it touched that area. It is now, to me, far more likely to bounce to this kind of level, 20,800, than it is to go down, at least 20,800, 20,900. So that tells me that there's still some fuel in equities worldwide. So now you have my equity view. I think 2660 in ES is going to be the level that you want to really get involved in, and that you can buy even Europe and Japan for a good 3 to 4%, which is what you would expect if the dollar is going to strengthen by 2 or 3%, that these markets are going to be favored, and then we will reassess afterwards. The bonds, as I've said, I think it's a yield curve steepener more than anything else. I think the 2-year is going to be pretty anchored at these levels, and that the 10-year and the 30-year are going to be giving up some ground. For the next 2 or 3 weeks, that is probably the most likely scenario. So our biases for the second real week of the year, where people really start trading, still the same here. I haven't changed anything. Would like to see these retracements to 118.50 and 267 in the 5-year. That's still my view. My view is still that Bund and Bobble are only to be traded on a spread to the US or to Italy or whatever you like it. Bund and Bobble don't exist anymore as far as I'm concerned, simply because the ECB owns them all, and basically the price is dictated by the ECB. I will not play that game. Now, what did I say XPX 2 weeks ago? Major league chop 2560, 2400 for at least a few weeks. Well, I got the range wrong. I think now it's 2560 to 2640 for a couple of weeks, that kind of level. Maybe 2660 as we saw on those charts. But that's it. What's a percent between friends, right? move will be slower now because plenty of people believe in the Fed put again, and there will be buyers underneath. As I said, it's fundamental data that this market will seek. It has to get in a position to be ready to dump on fundamental data, and that will only be when people have bought all they need to buy and are disappointed. At the moment, that is not going to happen in the short term. NQ, I still don't particularly like it. It's certainly going to be more volatile than XPX, both on the upside and the downside. But it's lost leadership. NQ is not what it used to be 6 months ago. And it will not be what it was 6 months ago for a long, long time, I think. Right, VX, I said, not as bullish as all that. Yes, expect much better levels, 23, 24. Well, I was right, but the wrong levels. As I said, now you're looking for 1650. That is going to be an absolutely fantastic level to get involved in on the long side. And I will put it in red so we remember what I said. 1650 is my level where I would like to get involved with in volatility. European equities, there's nothing bullish, but I cannot be bearish here. It's going to be a drift up to that 11,300, 400 level in the DAX. I just see no reason to do anything in European equities as opposed to in the US. DX 9507 is the level that we said, and it traded. That's support. It's better to be long of dollars than short, with a stop below the 200-day moving average, which is around the 94.90 level. But 93.63 is still going to be the very important swing level. I still think that this year, at some stage, you will see a migration of volatility from asset markets to FX. It makes macro sense to me. And if that happens, you will see a huge move from 93.63. I mean, it could be Plaza Accord type size. When the Plaza Accord came out, the dollar went from 280 to below 2 against the Deutschmark. So what's that? 3%, 30%. That kind of move. I mean, we are talking big stuff. And that is going to be my key, or naturally, you know, somebody in the US administration coming out and saying we want a much lower dollar, which I think at some stage they will. It's too early, but I think they will. But that is my key level for the year. Thank you very much indeed, and tweet you on Monday.